So, hello everybody. Today is Wednesday, February 2nd. I tell people that January flew by, but in some ways it felt like forever. I don't know if you all agree, but it was a tough month in the market. So today, what I wanted to talk about is the SPX trade, because I actually have went back and studied on their strategy and what went well, what went wrong, and have kind of revised it so that I think it'll be a lot less hectic and hopefully not have any big drawdowns. So, so first of all, kind of what happened. And like we say a lot of times, this strategy worked great until it didn't. And really, we were kind of hampered or hurt by the January sell-off. And nobody could have expected at one point, almost a 10% pullback in the SPX, worse in some of the other sectors, but almost got to the point where it just, our current strategy wasn't able to kind of adjust and keep them profitable. So, and then, the exit strategy, really works well, probably 90% of the time. It also doesn't work some of the time when you have kind of catastrophic events. And so kind of going back, I kind of wanted to see what we could do differently using these shorter duration trades. And how do we keep doing them? Do we drop? And so what I did is I went back and I reviewed all the prior trades. And what I really kind of figured out, and I've talked to a few people as well, and when you get to less than 7 days on a trade, it really doesn't give you much room if you have a big move that goes against you. So, so that's one thing, and we kind of knew that, but we were so far out of the money that it didn't really seem to wasn't going to be an issue until it was an issue. The other thing that I noticed is if we just sell really low delta strikes, the pricing can tend to be really terrible on your option spread if it, even if the strikes aren't in the money. And what I mean by that is, say, for example, you get 50 cents on a $5 wide trade, and you're selling something 100 points out of the money. Well, sometimes that strike, it might move down 20 or 30 points, and that 50-cent option now is $2. Have you all seen that? Where it just seems like, wow, that shouldn't be that bad. And I really think that's a lot to do with how much time is left in the option and the gamma risk that we run. So that was kind of the other kind of major takeaway. And then the last one is that I really need to tighten up my exit and trade management rules on the downside. So even though it only happens 10% of the time, 5% of the time, it's still too much not to focus more on how do I manage these kind of trades. So any questions or feedback so far on those things? Is that your kind of feeling as well? Okay, so so I went back and I said, okay, so if we were going to look at changing how we might be trading SPX, I came up with a couple, looked at a bunch of different options. One is you can sell the 15 delta strikes, and And that's pretty much close to what we were doing in terms of selling 7 days out, between 10 and 15 delta. And the only difference is adding an exit where we would exit at 50% of the credit received, or if the credit grew to 2 times the credit. So that was kind of one option. It really was kind of just taking what we're currently doing and just adding those exit rules. The second option is, instead of just selling one side of the spread, we can actually go further out and sell options on both sides of the trade, an iron condor. And we would, in this case, just using the same exit rules, exit at 50%, or if we got to 2 times the credit received. The third one was looking at selling a 30 delta. So we're going a little further or closer to the strike. We'll get more credit. And again, using the same exit rules. And then the last option, which somebody had suggested to me, was basically selling an at-the-money strike where you are either going to make a full profit or lose. So, for example, what I mean by that is if you sold an at-the-money strike on a $5 wide spread, it would probably pay you close to $2.50. So if the stock went up, you'd make $250. If the stock went down, you'd lose $250. So that's kind of the other alternative. I don't really feel that fits our model in terms of conservative trades. So I kind of threw that one out. But it is an option that that some people like. I don't personally want to have a 50, what you're really shooting for is if I can win 55% of the time, I'll make a nice return. Any questions about any of those alternatives or the exit rules? Does everybody know what I mean when I say a sell a 15 delta? Oh, okay. So, so after reviewing all of kind of the outcomes and alternatives, here is what I am going to be doing. So the first thing, instead of selling 7-day expirations, I'm actually going to go and start selling 14-day expirations. But I'm going to close it with 7 days left if I haven't reached my profit or stop loss level. Does that make sense? Because what that will do is that will take all of that, that last 7 days of gamma out of the trade. So it will keep us from having that trade, run up to the last day and kind of be worried about it. So that's the first major change. And then the second change is, if it is a bullish trend, if the market is kind of chugging along and it is a bullish trend, then my goal will be to sell 30 delta put spreads. And you can sell $5 wide or $10 wide. It doesn't really matter a ton. It's just what, if you want to reduce your risk, you can sell $5, or if you want to reduce the contracts, you can sell $10 wide spreads. In neutral or slightly bearish trends, my goal will be to sell a 10 delta iron condor. So if we're bullish, we're going to sell the 30 delta puts. If we're neutral or slightly bearish, then we're going to sell the $10 wide or a 10 delta iron condors. And then if it's a bearish trend, then I would be looking to sell 30 delta calls. Does that make sense? Any questions?
Your calls, are they spreads? I'm guessing they're not covered calls, right? On the
No, these are all,
allocation.
right. These will be a short call, a short call spread, either
Gotcha.
5 or 10 wide. Yeah, there's in this particular strategy, we would always be selling a spread. So first question I had was, okay, how do we tell if we're in a, a bullish trend, a neutral trend, or a bearish trend? So a couple of ways you can look at it is, a lot of times you can look and say, is the SPX or SPY or whatever you're trading this strategy, is it above the 50-day moving average? And the second thing is the chart in a, and I'll show you in a second. I have a couple of charts that will show it's green if it's in a long-term bullish trend, or red or neutral. So, and then the third thing would be the market scorecard. So if we look at the market scorecard and has lots of yellows and lots of reds, we're going to say we're in either a neutral or slightly bearish. If we're in a bear market, we'll all know that it's a bear market. So a lot of times it's really going to be hard to tell, is this, with the market over the last, few days, is this now in a bullish trend or a neutral trend? And you can make that call. And you could, the good thing is on the iron condor, it will work in a bullish trend as well. So it just has, more legs and things like that. So I will show you kind of the charting that I use a couple of places, and then, we'll, but a lot of it's going to be judgment. If you think it's bullish, then you want to use one way. If you want to be more neutral or conservative, then the iron condor way would probably work better for you. So here's a couple of trades using those two methodologies. I didn't do the super bearish trade. So this morning I was looking at the SPX. So at the time that I ran these numbers, the SPX was at 45.78. And I said, okay, in this case, I'm bullish. So I would sell the 2/16 expiration, 14 days out. And in this case, I'm selling the 30 delta strikes. So in that case, it was 45.85, 44.85, 44.80. That was a put spread. And the credit at the time was $1.15. So the risk would be $3.85, the credit $1.15. So the exit rules would be exit at 50% or 55 cents or $2.30. So in this case, if we exited for 55 cents, we make 60 cents on the trade. If we exit at 2.30, we lose $1.15. And we also have that time stop of 2.9. So if in 7 days we haven't hit our profit or stop loss level, we exit the trade. Any questions with that? Okay, so here is the iron condor trade. So same numbers as far as where the SPX was. And in this case, we're going to sell a 42.75, 42.70 put spread and a 47.25, 47.30 call spread. And that would net us around 95 cents. So even though we went out further and we have two basically credit spreads, we're able to collect 95 cents. And then the exit would be 50% of the initial credit received or 2 times the credit. So we're not going to stick around on these trades if they move against us. We're just going to exit the trade. And we would also, as it gets to be 7 days to expiration, we're also closing the trade. So we shouldn't have any major losses on any of these trades. And here's just a quick expectancy calculation. So in the first case, if we had a winning outcome, we would make $55. The probability is 70%, which would give us 38.5. On the downside, it'd be 115 loss, 30% probability for, so it would have a $4 expectancy per trade against a $400 risk, which would be about a 1% return in 1 week if we hit that. And if you just annualized it, that'd be 52%. So that is the 30 delta expectancy. And then on the Iron Condor, we would have a $45 outcome on a win, and I calculated it at 75%. So we have 33.75, and then we could have we'll have losing trades of $95, 25% of the time. So we have an expectancy of $10 per trade. So that actually worked out a lot better in terms of a 1 week and an annualized rate of return. And one thing that I did is I added this calculator to the conservative covered call spreadsheet, and I'll show it where it is. So you guys can go in there and calculate which, if you want to play around with the probabilities to see what the net outcome could be. And the other thing here is this is based on a $5 wide spread. So if you wanted to calculate it at a $10 wide, you would just have to change the capital here to whatever your net capital per trade is. Does that make sense? Any questions? Okay, so in summary, I'm revising my SPX trading plan to reduce major losses on the trade in a pullback. So if the market pulls against us, we're going to get stopped out, and we will, live to fight another day. Now, this, by getting stopped out on some trades, it may lower our win rate somewhat, because sometimes a trade will move against us, and then at the end kind of recover, and we would have made a profit. So we have to kind of accept that we would, it will lower our win rate, but it also lowers our, our net loss if a trade moves against us. You could use this on any 7-day trade. It's not just SPX. So if you were trading, SPY or IWM or the Qs or whatever you want to substitute for SPX, the same kind of reasoning would apply. And what I'm going to do for at least for the next 30 days, probably longer, is I'm going to actually, when I put on a 7-day trade, I'm going to do, if it's a question of being bullish or neutral, I'm going to put on both trades and track them and report back to the community what the outcomes were. And also, how did we match up to our expectations, our expectancy? And then we could use the same rules if we're looking at, say, a 30-day or a 60-day trade. So sometimes we will do an SPX that's 30 days out or 45 days out. We'd use the same rationale in terms of we want to close it at least 7 days early. We want to stick to our, capturing 50% of the credit, or exiting if it grows to 2 times the credit. And if you wanted to change that, if you wanted to say, I will stick around longer and go to 3 times the credit, you can use that calculator to calculate what your loss would be and what your probabilities would be. So that you could play around with that. So any questions? Does this make sense to you guys?
Yeah, it makes sense.
Okay. And if so, let me show you a couple of things. I'm gonna go and find the my spreadsheet. Okay, so I'm going to share with you the expectancy calculator. It's not really all that fancy, but it's just a way you can, and it's right under, I just added it as an expectancy calculator. And you would just, if you were, you would calculate your net profit. So if this was say, $100 and you're going to collect 50, you just hit that, and it's a 70% win rate. And if you say we're going to lose 100, it automatically calculates what your, what your expectancy per trade is, what the capital per trade is, and what a 1 week and an annualized rate of return would be. So and the way this would work is you could have, say, 5 trades of winning 50, 1 trade of losing 100. So you make whatever the net amount is. So, so you can change, the outcome, the probability, the net is calculated. This is all. The only thing is, if you're doing say you're doing a $10 wide, you might have a $900, and then these numbers are going to go up. So it works, the same way. So you can go ahead and play around with that. It's on that that spreadsheet that you all have access to. Is that helpful?
I have a question.
Yes, ma'am.
Maybe I missed something. How do you know what the probability is?
Well, that's a great question. If you're looking at there's a couple of things you can do. On Tastyworks, they will give you the probability of profit at 50%. And so you could use that, but I would always back that off a little bit, because it doesn't calculate the stop loss rules per se. So if it has like an 85% probability of profit at 50%, I'd probably go use 75.
Okay.
And you can also play around with this, say, how low can this trade be profitable so I still make a great rate of return? Like, for example, if you said, okay, I want to make a 68% probability and 0.32, it will calculate that for you. So you can say, okay, I think the strategy will be correct 2/3 of the time. And then that's the kind of return you can expect on the trade over an extended period of time. Does that make sense?
Yeah.
So, and again, you can change this number based on, are you using a $5 wide spread or a $10 or whatever, if you're doing $25 wide spreads, you can just plug in what the capital is for that particular trade. So, and then, so y'all see the markets scorecards, and let me show you on on TradingView. I use I have an indicator that will go in and will show if we're in a bullish trend, it will show green. If we're in a neutral trend, there'll be no color, and then a bullish trend if it's green again. So that's one way to look at it. Again, the other way is to see if we're above the 50-day moving average, or you could look at the market scorecard. So, and what I would probably do is, if in doubt, I'd probably move to the neutral. If we're, if we're, everything is just kind of humming along, well, then we want to use the 30 delta, because it's going to be probably the most advantageous in a bull market. So that is kind of my plan for the SPX trades going forward. And it really is trying to keep us out of any, major losing trades. And with based on the expectancy of the models, they should work really well if we stick to our stop loss and profit targets. And we don't stick around too long, so we run into that gamma risk. Does that make sense, everybody? Do y'all like the change or not like the change? Or you're not sure?
I think extra
Everybody's
time
on
in
mute.
this market is good.
Yeah. I'm sorry, someone else was saying I couldn't hear it.
I said everybody's on mute.
Yeah,
so
okay, well, that's, well,
That's why.
anyway, I just wanted to get your feedback. If y'all liked these changes, if you had anything else in mind on them.
I think the extra time in this market might be to our benefit.
Right. And one of the goals that I set out for the whole community was we want to be less hectic this year than last year. And so you can probably, I don't know if you can tell or not, but we're doing less hectic trading so far. We're still working out of some of the positions, but the goal is to, have a good steady stream of new trades, but not all the last minute adjustments and things. So
we're graduating to the next level, right, Brian, from the knowledge base that you've helped us acquire?
Well, I mean, I one of the things that I'll tell you is that I'm going to be, crystal clear on what works and what doesn't work. And when something doesn't work, I always kind of go back and spend a lot of time trying to analyze, okay, what could we do different, better going forward? And that's kind of what I did here. And so that's that part. So thanks for the feedback though, bud. Anybody else?
Hey, Brian, how did you choose, or did you look at the 30-day versus the 14-day expiration?
I want to do both.
Oh, you're still doing the 30. Okay, I got you.
Yeah, but this is really just kind of a substitute for the 7 DTE.
Gotcha.
So, and again, I think the rules that will apply. I think the same trading rules and kind of thought process, it would be the same. If we're neutral, we're going to do wider iron condor. If we're bullish, we're going to do probably more like a 30 delta. And there's nothing magical about 30. I mean, if it ends up being 28 that has higher open interest, that's the one we're going to select. Good question though, Dave. Any other questions? Okay, I'm going to stop the recording.